Hello, I'm Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our March 2026 Review and Outlook presentation. Regardless if you are listening to the audio podcast or watching the video, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlooks. For more information, please contact your financial advisor, and thanks again for joining us. The theme for this month, for March 2026, is resilient by design, why the U.S. economy keeps surprising. And this is especially important given today's uncertainties. Now, a lot of the data that we'll be talking about, looking at, are as of the end of February or early March, but it still is important to understand because it reflects the underlying kind of quiet strength of the U.S. economy, which is a real differentiator for the U.S. versus some other countries, and probably not what you're hearing about in the headlines and media. So let's talk about the broad outlook. The structural resilience, despite the geopolitical headlines, the U.S. economy is supported by a diversified resilience that continues to defy pessimistic forecasts. We've seen productivity gains. While jobs growth has absolutely cooled, we've seen a large increase in productivity that generates higher revenue per employee, per worker, and is driving U.S. economic growth. The U.S. is energy independent, meaning it's a net energy exporter, which keeps us, on a relative basis, keeps the U.S. relatively protected from global shocks that might have larger impacts on other countries in Europe and in Asia who are more reliant on energy imports than the U.S. is. This is very different from the 1970s when the U.S. was the world's largest energy importer. It's a very different situation, at least for the United States. We do see sticky inflation. We see these supply chain risks coming from what's happening with the Strait of Hormuz, for example, and other factors that are likely to keep the inflation somewhat above the Fed's long-term target. Now, that's only 2%, that target. But we do think that the Fed continues to march towards more normalization, with interest rates coming down to, over time, roughly that 3% normalized rate that the Fed themselves projects. And we expect to see some balance here with Federal Reserve policy and ultimately kind of receding into the background, which we think is good. So let's talk about the labor force and changes in monthly jobs growth. So the unemployment rate has remained very steady even as jobs creation has declined. And why would that be? Well, one of the major factors is the labor force. The growth of the labor force has declined as well. So we're just not adding that many more workers per month like we had historically. And because there's not as many new people coming in the labor force, there's one of the reasons why the unemployment rate has not increased even as jobs growth has cooled. And you can see this in this graphic where the blue line represents the growth rate of the labor force on a monthly basis. And you can see it's quite volatile, especially relative to new jobs creation. But they're both heading in the same direction, which is lower, sort of an odd balance or an equilibrium that we think doesn't last forever. But in the near term, that's why you can have such slow growth in jobs creation, yet not an uptick in the unemployment rate, because we're kind of in balance right now. So we do expect modest employment gains throughout the rest of 2026 as the bulk of the federal government jobs reductions are behind us. So we think the things actually stabilize or pick up somewhat, but more muted relative to historical norms. Here we're looking at on this graphic, this is the probabilities of where we're going to end up with federal funds rates, so short-term interest rates set by the Federal Reserve by the end of the year, or at their last meeting in 2026. And the current rate of range of 3.5 to 3.75. There is in fact, in the latest readings, there is a higher probability of no rate cuts at all, but there's still bias towards rate cuts. And so we expect over time we'll be getting closer to that neutral 3% range. And the Fed over time will be receding into the background and letting really the drivers of the U.S. economy do their work, and that is primarily the private sector. So we expect more normalization throughout 2026. And looking at this next graphic, these are purchasing manager indices, and these are business surveys of the service sector and the non-service sector, or manufacturing and non-manufacturing sectors. And we're looking at them on a moving average. And what we could see here is a real uptick. We saw an increase in survey responses, first from the service sector in the second half of last year, and now more recently in the manufacturing sector. We were talking about with our recession tracker, if you've seen that, one of the strongest areas of the U.S. economy is industrial production today. Industrial production is the strongest level, the highest levels since before the pandemic. And we're not seeing that reported a whole lot in the media, but we track it internally. And here we're seeing a lot of positive signals coming out of, this is our economically weighted, so it is more tilted. Our economy is more tilted towards the service sector, so our measure is more tilted toward the service sector, but you can see how it's absolutely accelerated of late. From late last year into early this year. And so the economy, the private sector is actually carrying a lot of momentum coming into 2026. And because the U.S. is not as tied to energy prices as maybe some other countries, because we are a net exporter, we think this momentum can continue throughout 2026. Now, granted, higher energy prices absolutely a headwind, but not near as much as it is for some other countries, and we're carrying a lot of momentum to begin with. So in this environment, our allocations remain tilted towards U.S. equities, specifically healthcare, industrials, regional banks, as well as small caps. On the fixed income side, we continue to favor the belly of the curve, so not taking a whole lot of interest rate risk, taking actually less interest rate risk in the market, and favoring asset-backed securities, where we get some additional incremental yield. To help manage volatility and enhance yield, we've got some equity options overlay strategies, as well as a multi-sector real return ETF that actually has benefited from some of these energy price increases, because it does provide exposure to commodities and the energy equity sector. So a summary of favorite choices, you can see here laid out on the table as well, just repeating some of the things that we just discussed. Now the cash indicator has increased, has elevated, reflecting some of the geopolitical and financial market uncertainties that we see out there. However, the current level is only getting back to the long-term median level, so it had been quite low. Increased equity market volatility has largely been offset by steady credit markets. So the credit markets still seem to be relatively confident in what's the economic outcome could be in the near term. So as it stands, the cash indicator does not suggest an impending market dislocation. Yes, there's some equity market volatility. Yeah, we've had some pretty good retracement in equity market levels. But when we look at the overall economic backdrop and the level of the cash indicator, we think investors should stay the course, and we think we'll work our way out of this in terms of the economic activity, earnings growth, which ultimately serve to drive equity prices higher. So with that, I will conclude by thanking for your time and your interest. Again, if you have any questions or would like further information, please contact your financial advisor. They'll be happy to help you.